Hi there, this is Christian Dye from Latitude West Financial. It is April the 19th, 2023. Today, I'm very, very happy to have my guest, Drew Kardash, from Alberta on Fire. Today, we'll be talking about cash flowing real estate, specifically in Alberta. Condos, houses, multi-units. We'll be talking about different areas in Calgary, in Alberta. And then I want to be talking about what you should be doing with your advisor, or possibly or possibly getting a new advisor in order to show you how to integrate real estate into your portfolio. So one thing I just wanted to mention is that the information here is for educational purposes only. So don't take this and just run away with it. Speak to a professional and always get involvement whenever you're about to make a large purchase decision. Okay, I want to just dive right into it. My team here at Latitude West, we are based out of Vancouver, but we do business across Canada. Many of our clients are in Alberta, Ontario area, as well as in other parts of Canada. We have another office in Ontario as well. And we go out to Alberta to meet with our clients, as well as to meet with teams like Alberta on Fire in order to find deals for our clients. Okay, I'm going to start with our first question. So Drew, what is happening overall in the Alberta real estate market?
Great question. What we're seeing right now is what we're not seeing right now is the massive drops in property values that you're seeing in other areas in Canada. The drops that you're seeing in Vancouver or Toronto, we're seeing slight drops in Edmonton, but we're not seeing massive drops. As far as properties on MLS right now, in Edmonton, we're seeing about a 3.7, an inventory of about 3.7 months. And what that translates into is, a seller's market is anything that we've got less than 2 months inventory. A balanced market is 2 to 5 months inventory, and then a buyer's market is greater than 5 months inventory. So we're seeing that the nice balanced market. We're hitting springtime in Edmonton, which means that everybody that's been thinking about selling their house since November of last year is starting to wake up. So that inventory is coming up. We're starting to see a lot more sales happening in Edmonton right now.
No, that's great. So this pretty much echoes the report that I gave at the tail end of December. And what I told my clients was, in Canada, we are expecting to see a drop in housing prices pretty much across the board, except for Alberta. And the stats showed that Toronto would go down somewhere between 10 and 15%. Vancouver would go down somewhere between 10 and 12%, but Alberta would go up somewhere between 4 to 6%. And it was the only province because of this. And part of the reason also was because your immigration coming in, and it could be Canada or outside. Can you tell me a little bit about how that's affecting the market?
Yeah, I mean, I'm getting a number of inquiries every day from people who are reaching out from those other markets that saying, hey, I can't afford to live in Toronto anymore. I look at the prices in Edmonton and my dollar goes way further if I were to buy. My rent is in some cases $500 more than I would have to pay for a mortgage for my own property in Edmonton. And yeah, I mean, you've probably heard ads from the government of Alberta. I hear it all the time from clients saying, we hear government of Alberta all the time saying, move to Alberta, move to Alberta. And, the city of Edmonton specifically is expecting an over 30% increase in population in Edmonton over the next 17 years. We're at a population of just over 1.5 million today, and we're expecting that population is going to grow to over 2 million by 2040.
And
It's
this
very exciting.
And off camera, we were mentioning it's about a 2% increase per year, and it'll be a
Correct.
30% increase overall. And those numbers are fantastic because typically when you see that rapid growth going into one concentrated area, usually you're going to see a run on supply, supply to rent, also supply to buy. And what's it looking like on the supply side? Are you guys pretty tight, or is there still quite a bit of selection?
On the rental side, it is very tight right now. We are seeing tenants that are getting massive rent increases and are not planning to go anywhere. On the construction side, we over the last 3 years, we've had some really interesting times with COVID and construction and everything like that. And what it's kind of come to is during that time, developers weren't really releasing land because they didn't know what was going to come of COVID and what was going to be the end, how long it was going to take. So they kind of tapped the brakes a little bit when it came to developing land and putting infrastructure in, because they didn't want to go ahead and service all this land if there was going to be no sales. And they kind of just said, okay, we're going to wait and see what happens. But now we're seeing like we're seeing a massive number of people trying to buy new homes, and the homes just can't get built fast enough.
Yeah, yeah. And I've seen that in other markets, like our Fraser Valley here in Vancouver. And I remember when there was this lull where all of a sudden there wasn't very much going on over there. You could pick up a house for $340,000. I picked up a house for 340. I picked up a condo for 112. And then I knew that the tide was shifting. I knew that there would be this urban sprawl of people moving out that way, and people who are immigrating who said it's more affordable in that area. And then all of a sudden there was like a 5-year crazy boom. And I do feel that Alberta, Edmonton is going to experience that. For individual investors, our next question, do you think now is a good time to invest, or do you think they should wait?
I do think now is a good time to invest. There's so much uncertainty, and what we're seeing also with the interest rate, now that they've had 2 reviews with no increases, it's gotten people off the fence. There's a certain level of certainty that wasn't there in December, and we're seeing people that were playing that wait and see game, saying, okay, you know what, I feel comfortable now. There hasn't been a rate increase in 2 meetings. I feel like this is probably the new norm, and let's get moving. So, we're seeing that balanced market inventory. There's still some hesitation from sellers to list. So I feel like there is good opportunities out there. Absolutely.
Yeah, so let's talk about areas. I'll put in my 2 bits first. If we're just focusing specifically on Alberta, Airdrie, Red Deer, Camrose, and then of course Calgary and Edmonton. Those are the areas that me and my team have actually been looking at quite closely. Have I have clients who have bought in Alberta in several of those areas. I personally, over the last 2 years, have bought 2 properties in Alberta. Both properties have actually already gone up. One of them quite significantly in value, just because, of course, I was able to get a nice deep discount during COVID. What are your comments on some of the areas that I've just described?
Yeah. So specifically in and around Edmonton, I would say areas like Leduc, which is just south of Edmonton, about 15 minutes.
Yeah.
Beaumont is just south and east of Edmonton, about 5 minutes. Those are great areas. We're seeing a real boom in Spruce Grove right now, which is about 15 minutes straight west of Edmonton. I really like Spruce Grove. They've kind of just unlocked or redone their zoning for basement suited single family homes and row housing. So there's some pretty cool stuff going on there. I really like Red Deer. I really like Camrose. They're good, solid communities. Calgary is always a fan favorite with people. Airdrie, again, it's almost like that Spruce Grove is to Edmonton. any one of those, if you can find, I think it comes down to finding the property that makes the most sense for your situation, right? And it doesn't matter specifically where you buy it. If you're looking for massive appreciation, Edmonton has traditionally not been the play for that strategy. If you're looking for big appreciation, I'd say Calgary is probably the go-to, because with the highs and the lows that Calgary gets, Edmonton is a little bit more of a steady Eddie. We've always been known as that cash flow king, so to speak, where you invest in Edmonton, and you just sleep well at night. I had Don Campbell,
Yes.
mentor of mine for a number of years. He always said, and it still rings to me every day that I think about it. And I'm paraphrasing here a little bit, but he said, keep your life interesting and keep your investments boring. And that's why I really like Edmonton, is it's just that slow, steady cash flow every month, cash flow every month.
Yeah. And I think like in my practice, that's exactly what I do, which I'm going to talk a little bit more about. And that's the analysis. I think people, they're on the fence because they say, like, I'll just speak for guys in BC, and they say, well, I can, if I look elsewhere, wow, your real estate is so incredibly cheap. It's so cheap. You can get a house for 300, 400, $500,000 in Vancouver. We can't buy anything. And then they're like, they want to jump. And I always say, hold on. Let's see what the strategy is. Let's do some analysis, because you're not going to get the 8 to 12% annual capital appreciation that we're seeing here in BC. But you are going to get better cash flow. So you're like, whoa, this place is, $2,000 a month or 2,500 a month for a $450,000 house. And then automatically you're like, those numbers, the cap rates and the cash flow is so much better. But I think it's that long term that you need to look at. And with Edmonton, you're right. The capital appreciation has been quite low. It's trending in the right direction, thank goodness. So I've always said, when people invest, sometimes it's like the game of baseball. If you go up to the plate expecting and trying to hit a home run every single time, you're not going to be a very good baseball player. There's nothing wrong with singles and doubles. There's nothing wrong with saying, I own 2 properties in Vancouver and I want to diversify, and now I'm going to own a place in Edmonton. My properties in Vancouver, outrageous capital appreciation, terrible cash flow, but my property in Edmonton, good cash flow, not so great capital appreciation. But that's exactly what a diversified real estate portfolio looks like. You invest in different areas, and they do, they will appreciate and they will cash flow for different reasons, but you just want, you don't want a lemon. And one of the reasons why I want to talk about that idea of a lemon is, you still need a good advisor. Like, I have bought a property right beside another property. One was good, one was bad, just because of the price we were able to get it at, just because, of the value of the upgrades that were done to the home at the time, or the value that you were able to add to the home at the time. So it's not really go buy Edmonton or go buy in Camrose or something like that. It really is more of a, where is their value? That's the macro, what's happening. And then the micro is, what's the individual property that I'm going to buy inside of it. And oftentimes I feel that people can't figure that out on their own. The realtor absolutely can help, but the financial advisor can crunch those numbers to see if it makes sense as well.
Yeah. And I think,
Off cam, yeah, go ahead.
I was going to say, to your point, having somebody that looks at it that way, you can work with any real estate agent. You can hire any real estate agent to help you find a house. But the one thing that we pride ourselves on is that we are focused on investments, and similar to your stance on what that looks like, you're a specialist that incorporates an entire view on investing, and you tailor your service to what that person's strategy is and what their goals are, right? If that makes sense.
Yeah,
We can help you buy
absolutely.
a house. Any realtor can help you buy a house, but if they don't know specifically what your goals are and what you're trying to achieve, you could be getting into the wrong property. And just because it's cheap and it looks good on paper doesn't make sense all the time. And you really got to
No,
delve into the details.
I agree. And the other areas that, the reason why you want a good team is, I know off camera we were talking about the great prices in places like Red Deer and Camrose, but you were mentioning your challenge is going to be property management, trades if it needs work? Talk to me about that a little bit.
Yeah, really. I mean, those smaller markets, you're going to have a really good tenant base. You're going to have a loyal tenant base. They're not going to pay, you know, the high rents that you're going to get in the city, but you're not going to have very many vacancies. You know, a lot of those smaller places that are well run, that are well kept, are going to have a waiting list for people to move in. But the problem is, if you're an out of town investor specifically and you're not managing it yourself, it may not get managed the way you expect it will, and you're going to have a limited amount of property management choices to take a look at, right? And same goes with trades for repairs and maintenance. You might have Bob that does all of the plumbing and electrical and finished carpentry, but you don't have choices on who's going to do that work for you and offer you the best service.
Yeah.
So couple of words of caution there. And I fully support people that love those smaller tertiary markets, and I think that there's good opportunity there, but just know what you're getting into headlong before you get into it.
Yeah, like for me personally, if I was to be asked that question, what are the areas me and my team are liking? Um, Edmonton, we definitely like certain areas that we feel are going to retain their value because of the infrastructure that's going on around it. You've got you got Nate Institutional College, you've got what's the university inside
University of
Edmonton?
Alberta. Yeah.
University of Alberta, and I know that they're expanding. I know you've got like the ones that I love: hospitals, post-secondary institutions, and airports.
Yeah.
Those three will always, if you are geographically close to those institutions, you're going to always at least hold and maintain rental vacancy very, very, very good rental vacancy, low rental vacancy rates, high
Yeah.
occupancy rates, and of course, then you're always going to be able to get that capital appreciation more than an area where because you're going to lose all the investors because they're going to say, well, it's not that great of an area and it's been vacant for 2-3 months out of the year. So those are the things I'm liking in Edmonton. The things I'm liking in Calgary are Airbnbs. Calgary has gone up. It has gone up, and their inventory is very, very low right now. But they, as you said, if there's capital appreciation that's going to occur, it'll probably happen to Calgary, and then Edmonton usually lags behind by about 6 months to a year.
Yeah.
But one thing that I find, and I do own in Calgary, and I have seen the capital appreciation, I think there's a lot more runway to move. But because of these high interest rates, mid-5 interest rates, it's harder to cash flow, which is why you either want a fairly inexpensive property that still has good rents, such as some of the places that you and I were talking about in Edmonton, or you want something with high rents, and market rents aren't that high, which is why people are moving out to Alberta. But Airbnbs tend to maintain, and if it's well run, now there's not all areas I would recommend for Airbnb, but there are pockets and there are certain condos that are Airbnb qualified. And I'm finding that the rental numbers are fantastic. So I think there is opportunity. I think there's opportunity everywhere. I do feel that in BC and in Ontario, especially Greater Toronto area and Lower Mainland of Vancouver, it's very, very hard to find an opportunity. If you're looking for cash flow, you can make anything cash flow. Just put a high enough down payment.
Yeah.
But I think in Vancouver, on a $800,000 2-bedroom condo, a lot of people don't have $300,000 to $400,000 as their down payment just to make it break even. Whereas some of our numbers that we could throw around over here, $350,000 house, $200,000 townhouse, $150,000 condo. Those are about the prices that I've been looking at with my team. That's probably around the pricing in some of the areas that we've described already.
Absolutely.
Yeah. Yeah.
Yeah.
So outlook for 2023, 2024, Drew, do you find that the prices and the inventory are still going to maintain? Do you feel that there's any signs of a pullback at all from your perspective?
If there is a pullback at all, Christian, it's going to be very minor. I feel like with the with the with all the energy around oil and gas right now, and just where things are headed with the amount of people moving to Edmonton, I feel like those prices are going to hold very, very strong. It's going to be flat or slightly elevated. I think it's good. I'm seeing, I was telling you, we've been increasing rents and everything. We've almost had to tap the brakes on a few. If you've got good renters in there, you don't want to be pushing people out. Our property managers are saying their amount of applicants is 10x what they've seen in the past, but they have to be a lot more selective now when they're putting tenants in. So we're seeing a lot of green shoots. We're seeing, rents increase. We're seeing property demand increase. We're starting to see, we're getting into that spring market again. We're starting to see multiple offers on a lot of sales again. So yeah, I think that there's certainly good opportunities here.
Yeah, like one thing I got to remind all the Toronto and the Vancouver people that they might not realize, but number one, there's no rent control in Alberta.
Yes.
So that means if the market rent is 1,500 and you're renting it for 900, you can go to 1,500. In BC, Toronto, we can't do that. And so it's a little bit more favorable to us landlords. And there's also no property transfer tax. Is that still correct?
No land transfer tax here.
No land transfer tax. So automatically there's some nice caveats over there. So I personally own property in BC, but I also own in outside of BC, and I also own in the US. So I think a diversification, like I said, I'm not trying to hit home runs on all of them. Nothing wrong with a single or double, as long as everything is increasing. Rents are increasing, capital appreciation is increasing. I'm not going to wait 5 years to buy a property. I'm going to see what is the best. As soon as I've got the finances in order, whether it be 6 months from now, or whether it be every 6 months, or whether it be every year, I like to buy. And I encourage all my clients to do the same. Speaking about where other opportunities in Canada are, I'm finding it's getting harder and harder, to be honest, to find opportunities. Some of the things in the description, we talk about multi-units. So what is a multi-unit? It's 5 units or above. And if it's 5 units or above, you can go to commercial lending. Commercial lending, the rates are higher, but the qualifying is sometimes easier. Like if you own too many properties, it's actually sometimes easier to get commercial lending on a multi-unit than it is for you to buy your 7th condo, for example. And
Yes.
I know when people here in Vancouver, Toronto think of a multi-unit, they're thinking $8 million, $10 million. But in your neck of the woods, I know me and my team, we've got multi-units from Alberta that are under 2 million, under 3 million. The multi-unit field over there is a little bit trickier as well. Finding a good one, learning how to analyze it, figuring out the capital appreciation, and of course, adding value. That's how you really make money in multi-units. You find a place where you can add value immediately, such as, putting washers and dryers in the units, rehabbing one unit at a time as the renter leaves. But there's several areas in all cities where there are just a lot of apartment buildings. It's kind of, and when you have a well-run one and everyone in that neighborhood knows it's well-run, it's crazy. It's like this building's got 30% vacancy, this one's got 0 vacancy at all times, and they're literally on the same block. And it's because one is well-run and the other one isn't. And I think that's where people who are at that level of looking at multi-unit, they have to think, can I add value to this? Because maybe they're picking up that other one pennies on the dollar because they know that there's value to be had and they can increase it.
Well, there's also a second strategy, and we've had a lot of success with it here in the last year, is with CMHC put together a program called MLI Select, and MLI Select financing specifically for new construction. So there's a couple reasons I love this. The MLI Select program will allow you to borrow up to 95% of the purchase price of the property with a 50-year amortization. And we're seeing decreases in interest rates of up to like 4%. People are are closing on properties today getting 4% interest rates on commercial lending. And it has just thrown gas on a new construction fire that that we're, people are clamoring to buy these things. And we're seeing like 8-unit, so we're seeing four unit row townhouses with legal secondary suites in the basement selling for around that $2 million mark. And these are cash flowing with a 95% loan to value in some cases, and like I said, a 50-year amortization. So it's kind of that one strategy for multifamily, as opposed to the one that you just explained, where you buy, you renovate, you refinance, and you you add value that way. And the thing I like about both of those strategies is, in the older multifamily where you're adding value, you get to kind of make it the way you want it. You get to add the value where you believe that value needs to be added, and you can increase the value of the neighborhood with that type of renovation. And what I like about the new construction is that now you've got an asset that's brand new, that's got 10 years of Alberta new home warranty on it. And, there's a next to zero vacancy rate on these things, because who doesn't want to live in a brand new property, right? And, the ones that I really love are, we call them the 3 stories, and they've got the basement suite, which is actually above grade. So it feels like you're in an apartment, but you're in a secondary suite.
Yeah, I think one thing to also mention about some of the neighborhoods you're talking about in Alberta is that we're still looking at like 2010 pricing on some of this stuff. So what I mean by that is townhouses for, let's say, $200,000 to $250,000 in some of these neighborhoods. That's what they were selling for in 2010, and you could still pick it up at that pricing now. That doesn't mean it's going to stay down forever. No, but and the reason why I kind of refer back to us Vancouver people of Abbotsford, Chilliwack area. I picked up a house out in Abbotsford in 2008 for $340,000. Pretty much the same house, 4-bedroom, same lot size, same neighborhood, everything. 5 years later was $345,000. It had gone up by $5,000 in 5 years, and I was going to buy that house as well. Financing didn't go through. I decided to let it go. But that was, I think, 2013 now. But from 2013 to 5 more years, that's 2018, that same house is now $800,000. And right now it's probably it's about $1 million, I believe. But the idea behind that is, these neighborhoods don't stay down forever. And there's a reason why, if they say that property values, let's say in BC, I think the average is 7% annual over the past, I think, 25 years, something like that. Some years, of course, we've been flat. Some years we've been gone up crazy. Let's just pretend Edmonton is 4%, not 7, but 4. Well, if it's been flat for 10, right, at some point it's going to catch up. Like, that's just how the math works. Like, it doesn't stay down. And if we say over a 20-30 year average, it's average. If we go back and say, oh, it's average 4%, and suddenly we have a 10-year where it's averaged 1 or 0, when it catches up, we still could be at the very, very cusp. And now you're saying that you're going to grow by 30%, 2% average on year. Plus, we're seeing all this demand. We could be at the very, very beginning of this boom. And this is why I like to give these webinars. It's why I like to mention the date at the beginning of these webinars, because whenever I'm making a recommendation to clients, whenever I'm making a recommendation to people who are listening, I like to, when these things tend to be correct, I like to remind people of the importance of having a good advisor, a good educator who's helping everyone to see value out there. But you got me sold for sure, Drew. I know you and I are going to meet probably now in April, potentially early May. For my clients out there who are listening, you really should try to reach out to see if there's of any interest. And if you're not a client, but you want to reach out to Drew, I'm going to show you how to get in touch. Or if you want to reach out to me because of the planning, then we can do that as well. So Absolutely, these are fantastic. I know in Alberta, I'm seeing a lot of opportunity in Vancouver, in these areas. The opportunities for the capital appreciation are absolutely there, but the down payment you're going to need is going to be quite heavy. Other opportunities in the prairies that I'm seeing, not as good as the ones that I'm seeing in Alberta specifically, because we have options of the Airbnb, because we have options of a lot of immigration coming in. Ontario, I find that it's such a large place, it's almost a mimic of BC. You've got the Greater Toronto Area, which has that capital appreciation opportunity, but at the same time, it's hard to find a deal at this time. So I want to transition now and talk about wealth beyond your financial ceiling. This has been a passion project of mine that is now being put onto paper. So I now have a publisher and a book editor, and some of the ideas that I've constantly been telling my clients for the past 15 years, we're now putting it, on paper so all Canadians can enjoy it. And right now, the title is not finalized, but this is the working title: Wealth Beyond Your Financial Ceiling. And what that means, and what the book's premise is, we all have a financial ceiling. So let's take a doctor and let's take a teacher. A teacher makes somewhere between $50,000 to $80,000 per year. If they put 10% of their income towards, a balanced mutual fund, RSPs, TFSAs, and include their pension, there is a number of the amount of wealth that they could achieve in their lifetime. That's their ceiling. If you have a physician who makes $300,000 a year, they put 10% of their income towards same thing, dollar cost averaging, balanced portfolio. There is an amount of money that they can make in their lifetime. The book is talking about breaking the ceiling, going beyond. And the story I'd like to share is when my parents immigrated to this country, their siblings came with them. So my mother, my aunt, and my uncle, 3 siblings, not too far from age, similar education, an engineer, an accountant, and an accountant. They come to the country, not very much money. They have about the same number of kids, 2 to 4 kids. They live geographically pretty much in the exact same neighborhood their entire lives. They work hard. So now we're going to fast forward to retirement, because all of them are retirement. So 2 of them own their home. They have a little bit of savings, probably under $100,000 of savings, and they're continuing to work part-time in order to manage their lifestyle. The third has retired with over $10,000 per month of cash flow on top of his 25 properties that he owns. He has set up 2 generations of wealth, not only education and housing for all of his children, but education and housing for all of his grandchildren as well. Now, reminder, these people they made all similar income, probably, somewhere in today's dollars between, $80,000 to $100,000. So this is the story of my uncle, and it's this story of the successful immigrant. What was their differentiator? What did he do that was so different than the others? And the quick answer was he integrated real estate into his financial planning. He wasn't a real estate investor. Now, he was also, now you think, oh, but that sounds like a lot of work. He did not manage all these properties himself. It's just like any other investment. You put it in place, you get property managers, you do all these other things, right? And I think right now, what our, society, what these financial advisors are telling us is that the way to wealth is through dollar cost averaging, balanced portfolio, into the stock market. Now, one of the things my book highlights is I have yet to find any average Canadian making between $50,000 and $150,000. I've yet to find any average Canadian who's become wealthy with that formula. I haven't found any. Maybe if you know someone who's become wealthy with that formula, you should let me know. And what do I define as wealth? Wealth is defined to me as setting up 2 generations and not affecting your own retirement. So if you want to travel, if you want to live in your home, and we're not talking about downsizing your home and then giving the equity to your kids. I'm not talking about that. I'm not talking about you no longer being able to travel. I'm talking about you having an abundant lifestyle and helping the next generation and helping charitable organizations. And the only way that I have ever seen it, and the book has many, many stories of people who have done this, but they've all done it with investing in real estate, right? As with a portion of their portfolio. Yeah, there's nothing wrong with having some money in the stock market, but having all of it in the stock market, to me, it's insane. It's crazy. I don't know why anybody would do that unless they enjoy the volatility and the whatever 4 to 8% annual returns that you're going to get. So what's wrong with dollar cost averaging with index funds? The quick answer is you're just not going to be rich unless you're putting what, 40% of your income towards it, which most people cannot afford to do. Why the wealthy invest in real estate and why you do not. Are you with the wrong advisor? So, I want to talk in my book about the Tiger 21. These are the wealthiest investors in the world. We're talking ultra, ultra, ultra high net worth individuals. They need 10 million minimum just to be part of the group, the Tiger 21. And the average investor has between 80 and $100 million. So here is the asset allocation for the Tiger 21. 31% is in real estate. If the wealthiest people on the planet are putting almost a third of their assets in real estate, then my question is, why aren't you? And I'm not talking about REITs, by the way. I'm not talking about REITs. I'm talking about, these guys own apartment buildings. These guys own shopping malls. These guys own, land. You might not be able to buy an apartment building, but absolutely you can integrate real estate into your portfolio. The next group I talk about in the book is the Canada Pension Plan. So the good news is, for those of us who will be enjoying a CPP Canada Pension Plan, these guys are killing it. They are one of the best pension plans in the world, if not the best one in the world. Okay. They have averaged 12.48% annual rate of return, beating the S&P by 56%. So that is fantastic. That is fantastic. Now, here is the shocking part about the Canada Pension Plan. They have got 23% of their assets in fixed income. That's like cash. That's making almost no money. Like, it's probably making less than 3% annual. So how can they have such a high rate of return? Look at their real estate exposure. Their real estate exposure is significant, just like the Tiger 21. And what I'm finding is, the more research I've done in my book, is the ultra, ultra, ultra wealthy and the large, large, large institutions who are making significantly better than average returns have significant portions in real estate, So the value I add to my clients is I help them to figure out how can they integrate real estate into portfolio. And if they're already doing real estate, how could we integrate more or get a higher capacity? Remember, with real estate, you have options. So when I bought my house in Abbotsford as my rental property, I don't live there, it's my rental property. Within 6 years, it had enough equity for me to buy another property. So I bought a $250,000 condo in Abbotsford. That condo today is worth about $520,000. So one down payment in 2008 has generated 2 properties. Okay. Then in 2018, we generated another property based off of a different asset that also had equity inside of it. So now we're building a real estate portfolio. The one thing I want to highlight is you cannot do this with stocks. You cannot do this with, nor should you. I know you could take stocks on margin. I would never recommend that. I would also not recommend that you leverage to, do anything really, really dangerous. So the philosophy here at Latitude West has always been, have a portion of your investable assets in the stock market. It still has a location because, of course, of liquidity. Real estate isn't a very, very liquid asset. And there's also some tax advantage of having some RSPs and TFSAs. But absolutely, how are you going to break your wealth ceiling without real estate? I've done the math, and I still can't find a math formula that breaks your wealth ceiling without having real estate. But I have multiple stories of, my first profession was in teaching. And when I was a teacher full-time, I knew 3 people over 12 years that had completely broken their income ceiling. They didn't have a side hustle, they didn't have a side job, but each three of them retired early. They all had at least 4 properties. They had more than enough wealth to set up their children's down payments, and in some cases their entire housing, and set up their grandchildren's. And we're talking anywhere they wanted to travel. They didn't have they couldn't spend the money in their lifetime. That's how much they had. And of course they didn't go crazy with it. So their lifestyle was probably, just not too extravagant to begin with. But the whole idea of it is, I call them the average Canadian. And the average Canadian has a story of breaking a wealth ceiling. My teacher colleagues had did it. My uncle had did it, but none of them could have done it without investment real estate. So my practice is centered around a fee for service. So those high MERs that everyone's trying to avoid with their stock portfolio. So they're either doing it yourself, or they're doing Q-Trade or Questrade. Well, there's problems with doing it yourself as well. You're probably not going to get rich either. Why? Because again, you're not going to have enough investment real estate, or you're not going to do real estate. You're just going to essentially be saving on fees. So what we do is we do a fee for service. If you want to invest with us, great. If you don't, that's fine as well. But imagine having a financial advisor that now looks at your insurance, your investments, your retirement. But if you want to invest in real estate, they will now be able to help them. So how do we help people invest in real estate? We are able to help find those properties that you are, anxious to invest in. And we are not realtors. Drew's the realtor. I'm not the realtor. But we can help you to analyze to say, is this a right idea or not? And the realtors, whether it be in Vancouver or Toronto or in Alberta, you might come across something, but you just don't know whether it's a good deal or not. Well, we could figure out whether it is a good deal. There are 3 numbers that we look at. One is the cap rate, one is the internal rate of return, and one is the cash flow. And if we were to meet, I could explain why these 3 numbers are so important. But really quickly, we want things that are cash flowing, or at least break even. The internal rate of return is the comparison of what we can get if we were to just put it in the stock market. So the property that you're looking at right now, and on purpose, I don't put the neighborhood in it or the city that it's in. It has an internal rate of return of 15.5%, and that's an annual rate of return over 20 years based off of your down payment. Based off of your down payment. The property itself might be growing at 3 or 4%, but based off of your down payment, remember, 25 years later or 30 years later, depending on your mortgage, this property is now yours. And the way we analyze it is, of course, we're number crunchers. We have software that helps us as well. We will include vacancy rate. We'll put a property management fee of 10% in there. We're only putting a value appreciation of 3%. We're not using some Vancouver number over here of 7%, only 3%. But year 1, on a monthly basis, this thing is going to cash flow. We're looking at a great cap rate. We could also analyze what your cash on cash return is going to be. And depending on the year that you sold it, minus, fees, realtor fees, we could also figure out what your annual rate of return is going to be and the amount that you're going to pocket. This is the type of financial advising that I believe everyone should have, not just, opportunities in the stock market, but also opportunities elsewhere. I'm loving Airbnbs. There are Airbnbs now. There are a lot of Airbnb friendly condos, but you're like, well, where are they? And, I don't know where these things are, and who's going to properly manage it? Who's going to do all this? Is this even a good idea? I've been hearing about it. Isn't that the whole purpose of a financial advisor? To help advise you on investments, right? And so I want you to imagine having a financial advisor that would actually tee it up and show it to you. And there is no profit on my side, whether you buy this place or not, right? But to be able to say, here's what your cash flow is going to be. Here's our assumptions, here's what it'll look like if you were to purchase a property like this. These are all home run style investments that are only 20% down payment, that would for $100,000, what can we expect is our best case scenario in the stock market? Well, if you get a 7% rate of return in the stock market, your money should double every 10 years. So 100,000 should turn into 200,000. Well, in the real estate market, 100,000 can buy you a $500,000 property. A $500,000 property over 10 years, the right property is going to go up significantly more than $100,000 because the mortgage is going to go down. So you're going to get the equity on that side, and the capital appreciation is going to go up. Plus, you're going to get the cash flow off of the rent. Remember what happens with rent. Rent goes up over time, mortgage goes down. So now that stock is now competing against, I guess, this killer rent. So I don't think a dividend goes up over time. It usually stays flat or pulls down, right? What does this look like in retirement? That's what the financial advisor will do. They'll be able to integrate this. And with the type of work we're doing, we're looking at how are we going to set up the next generation? We're going to look for tax efficiency. We're going to say, is this going to affect, my retirement? And then, we take a look at your financial health status. Are you strong? Are you partial? Are you insufficient? So now we put on the hat of all of the goodies that a financial advisor does, right? To figure out how does this integrate? Is this a good idea for me to buy this property or a second or a third or a fourth property? Should I be utilizing maybe some of my TFSAs and shifting the money towards buying one of these wonderful properties that Drew is talking about out in Alberta? And that's why our financial model is like this. We're very, very transparent with what we do. And for those of you, and that's why in the book, one of the subtitles is, are you with the wrong advisor? Are you with the wrong advisor? I'll tell you right now, and this is a pretty aggressive statement, if you're doing dollar cost averaging, RSPs, TFSAs, and that is your financial formula for wealth, you will not break outside of your financial ceiling. You won't, because mathematically you can't. But if you integrate real estate into this, then your likelihood of breaking it, if it's done correctly, is very, very, very probable. And I've done the math, and I also have so many examples, including my own. So what I want to do is I want to be respectful of time. I wanted to end off this webinar in 1 hour. So now would be that fantastic time to take questions. So if you had a question, by all means, for Drew or myself, you can put it in the chat. And while you are formulating your questions in the chat, if you wanted to have a complimentary meeting, probably over Zoom, with either myself or with Drew, this is how you can connect with us. So we also have websites, of course. Mine is latitude-west.ca, and you can take a look. And some of the other value add that we do, we work with a lot of incorporated professionals and show them how to invest inside their corporation, whether it be real estate or not. A lot of physicians, a lot of dentists, a lot of business owners, but we also deal with young families. Families who are starting out and they're just saying, what would be my first step? What can I do in order to start, leading a life to break through my ceiling? And then for Drew over here, he is in Alberta, but he's also got a big team in Alberta. It's not just centrally located in Edmonton. It is in other areas of Alberta. I don't know if it's the largest team, but Alberta on Fire is, they have a very, very strong presence in all these different areas. So, Drew, I'm going to start off with the first question for you, Drew. So my question is this. Do you find that there are pockets of neighborhoods that increase faster than other pockets of neighborhoods in the area which you've been describing? And if so, what's the attractive feature of those pockets?
Well, you already alluded to it early on in the webinar here, Christian, just on your philosophy on following infrastructure and announcements of infrastructure. So where we're seeing the largest increase in appreciation, I would say, is Southwest Edmonton. And that's because of the new hospital that's being built there here in the next 5 years or so. LRT expansion out to the west of Edmonton, down to the south of Edmonton. The Edmonton International Airport is south of Edmonton. So all of those things are really pushing people to want to live in Southwest Edmonton, South Edmonton. Spruce Grove is another one that's another hot topic right now. Spruce Grove out to the west of Edmonton. It's just really family friendly, good access everywhere. Highway 16, Anthony Henday, Atchison Industrial Park is out west. It's just really good opportunities in both of those spots.
No, that's fantastic. You know, what I'm finding is that I believe that one day we're going to look back and you know, when I talk to people and I sort of throw around and say, you know, my first 3 bedroom condo was I think it was 320,000. People are like, oh my goodness, I can't believe you bought a condo here in Vancouver for $320,000, right? Or when I say I bought my house for like $800,000 here in North Vancouver in the Edgemont area, and when I think we're going to look back on both Calgary and Edmonton, and we're going to be saying the same thing. We're going to be saying, "Oh my goodness, I can't believe you could buy a townhouse in Calgary for $220,000. I can't believe you could have bought, you know, a house for $390,000." And because I think, and the reason why I say this is just because, you know, like in Abbotsford, Chilliwack area, when people hear you bought a, you know, 2 bedroom condo in Chilliwack for 112,000, you bought a house for 340, and they can't believe that. And I'm like, yeah, and it wasn't that long ago, you know.
Yeah.
All right, we have a question here. I think it's a question for you, Drew. Thoughts on St. Albert?
I love St. Albert. I think that St. Albert is another one of those communities like Spruce Grove where it's got really good access to Anthony Henday and kind of those Highway 2 north of the city. And you know, St. Albert is a really interesting community where people are really loyal to that community, and it's got a little bit of swagger to it, I would say, and it's really, you know, vacancy is really low. It's got a really cool vibe to the city for sure. I like St.
No,
Albert.
no, that's fantastic. That's fantastic. Yeah, you know, when it comes to areas and expertise, one of the things I always recommend with clients as well is that you work with someone who knows the area quite well, someone who it basically specializes in it. And I guess, you know, that's for anything. Even when I work with a realtor, I usually just go with the person in the area. And I know with my practice, one of the reasons why a lot of my clients like working with me is because they don't have the time to figure out which are the areas are the next best thing for the down payment they have. Like a lot of my clients have a down payment. They don't have enough to buy anything in Vancouver though. So I'm not going to tell them wait another 5 years until you have enough to buy in Vancouver. Because the thing is, you probably will always be behind our market anyway. But again, there's nothing wrong with not hitting a home run. Let's hit some singles and doubles and let's just get the money moving. And then that's why so many of my clients are looking outside of BC with my help. But the other advantage is once they don't have that trusted relationship with people like yourself or the trades or, you know, what's going on in the area or the property managers. So whenever a client works with me, they don't only get me, my years of experience, my expertise, but they also get my Rolodex. They also get all of my contacts. They also get, you know, all of that infrastructure, like all that extra support that they might need. Like you kind of said, you know, maybe I might help somebody find a place in Red Deer, but I'll be very transparent with them. It says we might have some challenges because the place that we found needs a lot of renovations. And we might have to stick with the rent that we have now, and all these ideas of adding value might not come right away because of, you know, the trades issue that we're having. Okay, so here's our next question. With a 50% down, $50,000 down payment, what are the first areas you could think of in Alberta to invest in? I know what you're going to say, Drew. It's probably going to be the same words out of my mouth over here, but you go ahead.
Yeah, I love Edmonton, and I was talking with Christian earlier. There's some opportunities with these older townhouses, and you know, you can buy these townhouses for $200,000, and these are the ones that haven't really increased in price since 2010. And you know, last year we sat down as a team, all these real estate agents sat down as a team, and we started seeing prices go like on the daily, prices were increasing. And we sat down and we said, okay, what is the next asset class? We saw single family homes with basement suites was the first thing to take off, then single family homes. What are the next things that we're going to see an increase on price on that haven't moved yet? And it was half duplexes. And it wasn't 2 weeks after that we were seeing $20,000 jumps in the half duplexes. So as the interest rate rises, we're seeing people get squeezed out of those higher price points down into these lower price point assets. And what we haven't seen much movement on is townhouses. These older, 70s and 80s built townhouse complexes, 3-bedroom, 1-bathroom, 3-bedroom, 1.5-bathroom. We have not seen the price increase dramatically on these yet. We're starting to see days on market come down, so we know that the interest or the interest in those properties is starting to come up. And as Edmontonians, we don't put enough value on areas around LRT infrastructure. Edmonton's very much a driving city, and I keep telling my clients, in 10 years from now, if we get half of the amount of people that they say are going to move here, with the price of gas going up, with the price of utilities, people are going to start relying on LRTs more often. And a lot of these townhouses are built around these LRT stations. So if you can find a good condo complex in these areas that have a good steady condo board, that have good, condo fees aren't dramatically high, and you feel like it's a well-run property, that's a great place to park $50,000.
I love it. Drew, we're getting close to our end over here. Everyone's got our contact information. I think the amount of value that we have brought, I think everyone should be very, very grateful to both of us. And the best way that you could thank us is if you are in the situation where you do want to talk, you reach out. Or if you have a friend, a colleague, and you're maybe listening to this recorded link, we are going to send the recorded link to everyone. Forward it on, forward it on. You never know. You could change someone's life by suddenly, helping them to make their next real estate purchase just by introducing us, So, Drew, I'm going to say thank you. And until next time, you and I are going to probably see each other in the next couple of weeks. And then for my clients or people who want to work with me, I could be your eyes and ears for when I make that visit as well, if you want to reach out. So with that, I will see everyone again soon. And Drew and everyone, have a great rest of the day.
Thank you, Christian. Take care.